Good morning. Hello, everybody. So our last night, our last day, our last moment in San Francisco, I would like to start by thanking my ambassadors. They keep me honest. They tell me the truth. One of them yesterday gave me some shit, and I gave him some shit back. I don't know where Sean is, but I'm sorry, Sean. I love you. Yeah. And thank all of you for everything. I impulsively booked a ticket to Berlin to meet my wife, so that's where I'm headed next. I can't wait. She went to do service in Berlin with a friend of ours and spreading her light, and I'd like to thank you for spreading so much light this week. This is a particularly hard week, but I think it's exactly what we predicted going into it, that there's a lot of change going on. It's not really clear all what it means, but there's tons of opportunity. I think all of you feel that way with everything that's changing. It may change your world a little, but we'll keep you informed and keep you abreast. Now, at 11:20, we have two people we really love, Andrew Flackner and Sarah at CAR, to give their 10 kind of takeaways, like what did all this mean and what did they hear? And then we'll have a half an hour with all of you where you share what you think is going on, along with any complaints you have about the hotel, about me, about the dress code, about Vegas, and so that'll be an opportunity to give us a lot of feedback. Also, we tried to build a lot of feedback into this, but I did get an email last night that we didn't build enough into it, so we'll continue to obsess on doing that and try to come up with new and clever ways to do that. This really is a community that kind of drives the course. It's not us at the top. So throughout the week and the days when we report on these things, get engaged, comment, put your opinions in our stories, reach out to us, join Facebook Coast to Coast. And I'm not trying to sell you anything, but you can get a super deal now, but join Select so you get all of the stories that Inman has going. If you have time and you have the resources and you're in the luxury market, come to Beverly Hills, totally different event. If you haven't been to New York, come to New York. It's totally different. We have some of the really stellar speakers that were here, but we have about 90% that are brand new. Our commitment every time is this industry is got millions of people, so why would we have the same 100 speakers over and over and over? So we don't do that like so many other real estate conferences. We're always looking for news tips. If you see something going on, shenanigans, or if you have a great story to tell, or if you've seen a cool technology, or if you think you're the best and we should profile you, always feel free to reach out to the news desk. Very easy to find us. Our editor, Carl, he came over from Vice, really good understanding of technology, but we also have a lot of contributors, a lot of writers, Emma and on tech and Andrea on the MLS and associations, and so we're only as good as the stories that you give us. If you're frustrated that you've sent an email or a press release, don't give up. I'm going to hand the mic in a minute to a PR guy, a publicist, and these are people that when you're in journalism, you don't kind of have some disdain for, but there's some really good publicity people out there that can help you, and the one that's going to interview Kara Swisher here in a minute is Audie Chamberlain. I'm not saying go hire them, but the characteristics of a good publicist is they're pretty pushy, and so don't be afraid to be pushy. But also keep in mind, sending us press release that you opened an office in Alabama probably isn't going to get our attention because we have to be attentive to the fact it's a national audience, and I think what you're doing opening that office is fantastic, but it may not be of interest to our larger readership. Always look for a news hook, look for something that you can imagine our readers would be interested in. That could be a trend, a statistic, a new product, and try to weave that into whatever you send, and then be patient. But also, don't just send it and hope we'll publish it. Be persistent and try to get our attention. I'd just like to thank you so much for being here and bearing with us through some, I thought, really great discussions and great speakers. We had that epic moment on Wednesday. I still don't understand it, but eventually I will. But it'll go down in history as something. And so hang till 11:30. A lot of people say it's the best session, but the morning is now devoted to Capital Connect, and there's some really brainy people, like probably too many MBAs up here, which isn't my preference of the planet. But I used to teach them, but I don't like them. No, I shouldn't say that. But really some brainy people, and listen closely, and it'll be a little off maybe what you do every day, but I think you go back understanding the whole capital flow. And now I'd really like to introduce two of my favorite people, Audie Chamberlain, who's going to interview one of my truly favorite people, and that's Kara Swisher, who tells it like it is, which is why I and many people love Kara Swisher. So come on up, gang, it's your show.
Oh. Wow.
These bacteria.
Oh. Okay. This is like The View, but not without Whoopi. Wow. Hello.
Good
Hello,
morning.
Meghan McCain. I agree with your father. Anyway.
Thank
You got that joke, right? Okay.
Thank you for
No
being
problem.
here.
No problem.
So, you've been in the news, but you make news, and now recently you've been in the news.
Yes.
And I think first I just want to congratulate you for the new gig at New York Times.
Thank you. Thank you. They sent me a tote bag. I'm very excited.
Yeah, and it's
They
interesting.
did. They actually sent me a tote bag.
Well, and
I
you-
was like, okay. Like,
You were at the Journal, and
I don't
so
want the
it
tote bag.
feels very like bookends. Like,
Yeah,
where do you go?
Interestingly, I worked at the Washington Post. I worked at the Wall Street Journal, and so before I die, I felt like I had to work for the last big newspaper.
Right.
So I'm excited. It's going to be an interesting thing because I think the tech needs to. I think tech needs to talk to the masses, and the masses need to talk to tech. And so I was really intrigued by the platform. It's not the news platform. I'm still working at Recode, doing the podcasts and the events and news and stuff like that.
Right.
But it's an opinion column, so it's what I think of things, and I think it's separate from the news. And so I'm not really going to mix with the news sections of the New York Times. So I think it'll be an interesting way to have a platform, a global platform, to talk about these issues because they've gone global, obviously. And the Times has done an astonishing job, in their news sections. They've done some really interesting things in the editorial sections. But people don't quite understand that they're separate. They're separate. They run separately, the editorial from the news. So it'll be an interesting. I've written lots of opinion columns at Recode, but it's often speaking to the industry. So I really want to speak to a broader audience, and so that's what I'm hoping for. And it's nice because like this morning, apparently the Daily is all about my interview this week with Mark Zuckerberg. And what was interesting about now that I'm working with the Times, I would say with because I'm not an employee of theirs. Now that I'm working with them, like yesterday there were 2 articles and they put my name and a link and Recode and everything else, and then today it's Kara Swisher, who's our new colleague, and before it would be like, it was written in a technology blog, and now of course I get attention for them, which is great. It's a great global platform to talk about these issues of privacy, automation, AI, Holocaust deniers, as it turns out. I didn't think I'd be writing about that, but here I am. And a bunch of other things. So it's a great global platform.
And really, that's why we're here. Is
Yeah.
Your opinions,
Yeah, I have a lot of them.
Those.
I have a lot of them.
So that's exciting. And
Yeah.
then, so you've also been making the news more recently with the exclusive
Right.
Mark Zuckerberg interviews.
Yeah, it wasn't exclusive. People say I don't use that term a lot.
Interesting.
Lots of people have talked to him. I just get him to say things.
Right.
So,
Well, it felt maybe that way because since all of the news, it was the first big
he's actually
story.
been quite out there. He's actually been doing these massive interviews with reporters. He does these long group interviews. He did like 10. I did a short one with him right before the hearings that came, the congressional hearings. Around Cambridge Analytica and other issues, he was going to come to our code conference, and then Cheryl went in his not in his place, but she went, and he actually messengered me, which is funny because I usually get texts from these people, and he went on Messenger, and I honestly don't use Messenger, and it sat there for days. Like,
Yes.
it's like, you want to do a podcast? And
happens to me all
I
the
didn't
time.
respond for like 4 days or something, and one of his people were like, hey, Mark wrote you a note. I'm like, no, he didn't. And they're like, it's on Messenger. I goes, who the hell uses Messenger? Not me. And so, so then I get on Messenger, and I'm like, oh, hi. Good. But then on Messenger, I have all these, I have a lot of Facebook fans and a lot of Twitter fans, so I get a lot of crazy messages on Messenger, like, I'd like to marry you, I'm from India, and I'd like to marry you, and would you think about moving here? I'm like, no, but thank you for the kind offer. So I don't use Messenger that much, and well, there he was, and I said yes. So he asked to do a podcast, which was great.
Oh,
Yeah.
That's how it came together. And you know, one of the
He
things...
wants to, to be fair to him, it was really something amazing that this is the most powerful technology person in the world, if not one of the more powerful people in the world in business. And he is very eager. I know what happened with his quote around Holocaust deniers, but that was 90 minutes he took to talk, and there was 89 other minutes of other things that were really substantive about him. And he's very thoughtful and earnest. He's extraordinarily earnest, probably too earnest, about a lot of issues. And so I thought it was really great that I give him credit. A lot of these people run and hide from me, and he didn't. And so I give him credit for sitting down. And at the end of 90 minutes, he's like, you want to keep going? And his PR people didn't. But, he's interested in all kinds of issues. We could have talked about the future of work. We could have talked about opiates. We could have talked about all kinds of things on that platform. And that he was willing, I do give him credit for that. And again, a lot of these people just they're not attempting to be self-reflective or answer to people other than the people that work for them. And so they get a lot of yeses. So I appreciate that about him. He's actually a very nice man.
Very cool. And one of the things a lot of people here have been asking, what do they look like in 5 years from now?
Oh,
and we said there's, obviously an umbrella there now.
Well, Facebook is Mark Zuckerberg. Let's be clear. A lot of this stuff, everything there are problems that are happening right now, and there are myriad. And it's worrisome. A lot of their problems are really almost beyond their ability to cope with them. What they've created is a real monster, and they haven't done a good job of controlling their monster. I don't know how else to put it. And they haven't been a good job of thinking. It's like, I don't want to impugn engineers because I think there's a lot of thoughtful engineers and people, but it's like a lot of people who didn't take enough humanities courses. You know what I mean? Because
it
what they're
lacks
dealing with, and it's not
human-
just them, it's YouTube and others.
Right.
I was at YouTube recently. Susan Wojcicki, I've known a long time, who runs YouTube, and she asked me to come in and talk to their staff. And one of the things that I was really struck by was, when someone put up a hand and they said, well, it used to be cat videos and now we're dealing with major issues that, it's an ethical dilemma every day, essentially. And so they have to they put themselves in between them, put themselves in the middle of humanity, and now they have to deal with the repercussions of humanity, which are largely ugly, unfortunately. And so I think it's a really difficult issue. So, as a platform for reaching people, I think it's great. I think in 5 years, I don't know, there'll probably be something else. I think probably some of the things they bought, like Instagram, is probably a better place to focus on, because that's turned out to be one of the cheapest buys of all time at $1 billion. Some of their other platforms, Instagram and Oculus, I think I would be looking at stronger than the Facebook platform, because I think, one, the Facebook platform is too big. It's too big to reach people. I think it's going to undergo an enormous amount of pressure around these issues of free speech and news and false information, and they're really doubling down on, awful people, like letting awful people say whatever they want. And my fear is that they're going to move into, if you think of Facebook, you think of Twitter. Twitter is like a really bad city, where you see the messes, like a badly run city.
Everything.
Perhaps San Francisco, you might say.
Yeah.
Right. Come on. This morning, literally, as I was getting in the Uber here, there was this thing that rolled down the street at me, a bottle. It was full of urine. I was like, hello, good morning. I was like, what the hell? Anyway, I live in a relatively nice neighborhood, apparently I don't. In any case, I digress because of this pee bottle that was at me this morning.
Twitter
Twitter
city.
has made a cesspool of itself. Let's be honest. It's a
Right.
cesspool. It's a noisy, nasty cesspool now, and they have done nothing to clean it up around the bullying. I know they say, oh, we cleaned up 70 million fake accounts. Well, what took them so long? Like, they want to pat themselves on the back over cleaning it up, but I'm like, I don't know. The rest of us have been suffering over here for years. Yeah.
For years, yeah.
So Twitter has gotten that far. Facebook has been like sort of if you want to do the city metaphor, a suburb for so long, like a really nice suburb. But suddenly there's glass windows have been banged out. Suddenly there's people screaming at you. Suddenly they haven't had good control of the platform, and they've also allowed people to split. Like everyone's in their little filter bubbles essentially, and so. I think it's a harder place to market. I don't know. I would imagine it gets to be a harder and harder place to market, which is what you're interested in, right?
Well, yeah, I think everyone's interested, in that idea of where's the marketing channel going to go. But
I think Instagram is an incredible. I've been experimenting with Instagram a lot recently. I think Instagrams are really. Kevin and I are about to have lunch. Actually, we've been texting a lot. He texts. He doesn't use Messenger.
Yeah.
But Kevin, this is the guy who founded Instagram. Kevin says.
I believe email's like the fax, personally. And I only text myself.
Carrier pigeons is what I'm going to. So I think Instagrams are really interesting, and I think the stuff they've done around a lot of their products, the stories and everything else is really well done. A lot of it borrowed from Snapchat.
Right, but
by which I mean totally stolen.
Borrowed.
Come on. Literally, you're like, what? Did you even pretend?
Stories.
Like, they don't even pretend. I did a great podcast with him. I like Kevin a lot. I've known him a long time. Where he said, well, so what? They invented the radio. We just invented a better radio. We just made a...
Right.
I was like, okay. It's still kind of shitty to do to
Right.
Evan Spiegel. We had Evan Spiegel. I'd recommend the podcast. I just did a great interview with him.
Cool.
And he was really fantastic. That was a fantastic interview.
So brought
Instagram is what I look at.
But you bring up a couple really interesting things. Can you explain to us fake news, what it really means? It's just this non-word.
It's different. See, the problem that Mark had is he wasn't different. There's things that are wrong. I get something wrong, not often, but people get things
Knock
wrong.
on wood.
Yeah, people get things wrong in life. Like, oh, I got that wrong. I got this wrong. That's different. Okay, that's not meant to be malevolent. It's not meant to be. It's just a mistake. And that happens all the time in life, and it happens on the internet just like it does in life. Then there's fake news that is actually meant for clicking, either to get you to go to a site for advertising means, or to say sway an election, or to do whatever. It's meant to cause a reaction, and it's absolutely inaccurate, and it's meant to be inaccurate. And so that's fake news, I guess, or false news. And that's meant to be. It's meant by malevolent players to take advantage of the system. And let me be clear, what the Russians did, Russians did hack. They didn't hack. Okay. They hacked this election. They absolutely did. There's only one person who doesn't think it. Everyone else does. It's so clear. It's so manifestly clear. And I got Mark to talk about it. He's like, of course the Russians use Facebook. Like, everybody acknowledges that this has happened. And so they were using it. They were using the tools as they existed. They were not hacking it. They were using Facebook tools, primarily Facebook, but Twitter and YouTube also, that exist. So they were taking advantage of existing tools. So they didn't hack anything. They just used it the way they were designed to be used. But they used false information, and they used all kinds of targeting and kinds of tricks and things like that. And then there's hoaxes. Hoaxes, which is, I think, different than fake news, which is InfoWars, which is a big controversy on Facebook. They're allowing InfoWars to remain on the site, and InfoWars, they put out things like Sandy Hook was not true, and the children were actors. It's so appalling.
Does that cross First Amendment? Like, when we start talking about hoaxes, I'm
not sure it's First Amendment. I think the First
Amendment.
Amendment.
Is it protected? When you create a hoax that maybe has some real.
It's an interesting debate. I think there's a lot of First Amendmentists, some columnists and stuff like that, who are just. As far as I'm concerned, they've weaponized the First Amendment, and every single thing should be. I'm a journalist, so I obviously believe in the First Amendment. But in this case, it's meant to damage and harm people.
Right.
And so, Mark has drawn a there's a really good Farhad Manji column about this. It's so confusing, all their different rules, that in this case, but not in this case, we're going to take off things that cause violence, but only after people are dead. You know what I mean? Like the kind of thing. They react after things happen because they, for some reason, aren't able to anticipate certain behaviors of humanity. And so, like yesterday in because of the issues in Myanmar and India, where people were dying because of WhatsApp viral emails that are communications that are going on. They used to be you could send an email that was false, for example, out to 250 people. Well, these mobs formed and then killed innocent people.
Right.
Now they're limiting it to 5 in India, so you can't do a viral message, and in the rest of the world to 20 people. Although I think 20 people would probably create a mob, but I don't know what the definition of a mob is. But so they're trying to take their tools and pull them back from what people are using them for, and so they're very intent on if it causes violence. But I don't know how they know what will cause violence. And I think, InfoWars putting up that these children were actors is violent towards the parents, it's damaging. And so you have to start to really weigh. And on just a basic human level, if I ran a service like that, they don't get distribution. But they stick
As a customer.
As a customer, yeah, exactly.
But are they a utility at this point?
Well, I don't know. They're making the determination that they don't want to choose.
Right.
I think it's pretty, I get their idea. They sort of have weaponized the First Amendment. Like everything is the First Amendment. And so it's a really complicated and difficult issue. And unfortunately, it's being decided by a guy who didn't finish college. You know what I mean? That's the problem. And so it's a much more, they've got to bring in ethicists, they've got to bring in all kinds of people because of what they have wrought. And I think that's my issue, is that they haven't thoughtfully thought this thing. I mean, they have thoughtfully, but really they haven't. They just haven't, because it keeps popping up.
Well, even live.
So when
how
we're
do you
sitting there
anticipate
saying,
violence there?
should I don't know. I'm an editorial person. We cut off our comments because I didn't want to hear from Holocaust deniers. I just don't want to give them a platform. They can create their own crazy platforms. There's plenty, it's easy to make a website, so I don't know if I would allow them on my platform. So it's kind of an interesting problem for Mark and for Facebook, because they have to start deciding what they want to do, because otherwise it gets overrun by people like InfoWars, Holocaust deniers. They have certain rules around pedophiles, I guess, at this point, hopefully. You start to really go, and then on the other side, you do go down. I know First Amendment people always like to use the word slippery slope, but it's a slippery slope on both sides.
Yeah.
And so that's the problem, I think. I wouldn't relish his job at all.
Oh, I want to shift a little to privacy, because, I was recently at an event where they were showing technology using face recognition that was then auto-generating in an automated way parking tickets or jaywalking tickets, it was, in China. And now this week we're hearing, recently about DNA results getting into, authorities' hands, and maybe that person didn't even really realize what, that they were signing off on this, or there's some,
Yeah. Well, just assume that this will be used by an autocrat at some point. Let's just assume.
Right.
Let's go right there. I mean, they all say this. Years ago, I had a discussion with one of the founders of Google. I can't remember which one, because I confuse the two of them when they speak to me. They both are sort of hard to talk to as people. So they call, and anyway, I was writing about their search. The fact that they had 90% of search in one place, and I thought that was wrong. That one company should be in charge of all of search, and it was monopolistic. And I think I used a term, and Google sort of used to try to put out this idea, we're good, we're Google, we have colorful balloons on our front site. And I was like, at least Microsoft knew they were thugs. I think that was the line I used, which wasn't very nice, but it was true. So one of them called me and said, we're not thugs, blah. And I was like, okay, but I think you are. I think you actually are. You don't even understand the power you have. And in the power with privacy, I was like, you have all this information on people. Look, maybe, and I think whoever it was said, I'm a nice guy. And I was like, okay, I know you are a nice guy, but one, what happens in 20 years when someone else is running Google with all this information they've collected? I don't know who's going to run Google. I'm worried that you have collected all this information about people, and someday it's going to be, and I did say at the time, it's going to be facial recognition, it's going to be fingerprints, it's going to be eyeballs, everything else. And so why one company collecting all this information, and in fact, people willingly giving out the information, to me, you've got to start thinking of where that leads someday. And so the stuff around facial recognition, around DNA, around all kinds of information, your phone following you everywhere, is really worrisome from a point of view is if you believe that autocratic rulers will use it. And guess what? Look what's happening around the globe. You've got an autocratic in Turkey and Hungary, there's Austria. It's like it's moving across the globe. These rulers. Erdogan just passed like 6 insane rules around journalists, around everything, and with more and more information. And if you think it can't happen here, you're absolutely incorrect. It really can. It really doesn't take much. And when these companies have all this information, especially around facial recognition, it's worrisome. And I would say some of it's really interesting. Like there's a thing, I think Mark Cuban has one of these companies where they have sensors everywhere, and they tell you when people go by a building, how, to give you an idea of where you should put coffee shops and everything else. It gives you, that's kind of cool. Like, it's kind of makes sense to how do people move? How do people park? How do people, so you can get an idea of how people use a building. Like, there's all kinds of things that are useful, like in terms of your business. And you really do get more than anecdotal info, because we really do operate on anecdotal information. This is real information about real movements. And guess what? Everyone has in their pocket a sensor. This is a sensor.
Oh, yeah.
There's going to be sensors everywhere, like that you go. And if you think of the applications for real estate, it's enormous, and it's interesting, and it's cool. And, I just was, all of it is cool, but you do have to start thinking about the implications on the other side when a country like China gets a hold of it, which is a surveillance economy. Like, they're a surveillance state. And what they can do with that is, look, I like people, but, I always say I like people in particular, but not in general. Because, do you know what I mean? Like, I like my kids, I like my mom, sort of, most of the time. But you have to wonder when these vast troves of information get in one place that we are actually giving up what could happen, and we have to. Unfortunately, if any of you saw the Mark's hearings. Legislators are completely incapable, inept at understanding the depth. If you watch those hearings, they should have been asking him very seriously what happened around Cambridge Analytica. Right. Very serious questions about what happened to our democracy, what happened to our elections. And instead, you had these bunch of idiots, really, pretty much, what about the terms of service? And I was like, what? Like, that's not the biggest crisis that you can't read a terms of service. It's not the biggest crisis on our planet. Like, are you kidding me?
Right.
Or when I turn on Facebook, I seem to get an ad. And then one of them was talking about this insane idea that your phone's listening to you. Like, it's not, by the way. Well, not today.
So I want to...
Our legislators are idiots.
I want to leave the room...
They are.
I want to leave the room with something they can take away over the next, let's say, 6 to 12 months. Like, everyone truly respects your vision as far as, technology. So folks in this room want to know what they should be thinking about. You already mentioned a couple platforms. Yeah. But tech, like raw tech, what should they be thinking about?
I'm really intrigued right now by, I know I'm going to sound like an idiot, but AR and VR, I think, is really, to me, what I'm going to be focusing on this year. I mean, I just recently, at first when Mark and I talked about this a little bit, he actually, if you listen to the whole thing and get past the Holocaust deniers part, there's a whole section at the end where we talk about AR and VR, and I think he's 100% right around the uses of it in jobs and work. And they bought Oculus, obviously. Google is in Magic Leap. There's all kinds of stuff going on. And I just recently did this thing, and you can listen to the podcast about it, where we put VR things on, and now you can put them on your back, so you're not tethered in the back. You're still wearing a ridiculous helmet, and we were essentially carrying a computer as a backpack. But my kids and I did this whole cool thing where we played a game, in one of those rooms and stuff. And for the first time, I could really see the applications of VR, of how you could go through a house, how you could go through I think that's a really interesting. I think that is something I would start to really look at. It's an AR, which is augmented reality, of how you do real estate, how you look at things.
Right.
I'm looking for a apartment in Washington, if anybody has any ideas. 3 bedrooms. And the search is ridiculously analog. I'm finding it really interesting. Like go to a site, look at these photos, and it just seems like there's a better way to marry me. I'm doing a lot of the digging, and I think there's probably interesting ways using AR, VR, and to really to create a marketing plan for someone to buy things. So I think that I'm interested in AR and VR. I'm very interested in some of the stuff around messaging, where really rich messaging happens with people, and using search and an AI smartly to marry people and their needs with the real estate needs. I think there's a lot going on in that, and the uses of AI to understand trends and things like that and what people want. So I would look at those.
We're going to leave everyone with that.
Okay.
And thank you.
Good.
One more time.
Sorry to bring you down about the Holocaust deniers, but you should listen to the podcast. It's great. All right.
Make sure to listen, and thank you so much.
For those of you standing or just arriving, there are still seats available in this room. If you have an empty seat near you, please raise your hand. And folks, please move into those seats. Thank you.
Where do you want to see yourselves in the next 10 years, 20 years? Do you want to go with something that is established, or do you want to blaze a trail in an unknown? You're in a room where people are living their best lives. It's not about how much volume they do, but who they are as people. They just want you to win, and you want them to win. And that's what makes it feel right. It's not just a business. It's a place that I can call home.
Here to give us an insider's look at present and future of real estate investing, please welcome Paul Shao with Canvas Ventures, Jason Stouffer with Maveron, Patricia Nikosh with Trinity Partners, and Clelia Peters with Metaprop.
Hi, guys. I think we're going to start with just a quick Slido survey of who's in the audience today. Can we pull up Dr. Slido? Okay. So are you an agent, broker, investor, tech entrepreneur, marketer, other? Seeing so far primarily agents, some investors also, other. Okay. So we've got a mixed audience. Great. So our panel is titled, Why Does Silicon Valley Suddenly Love Real Estate? And I thought we would actually start off with a question of, guys, why do you suddenly love real estate?
Been loving real estate for 20 years. I'm just going to say that right now. Since we first invested in LoopNet.
Yeah.
But I think the right now piece of that question, where I think there's been a particular enthusiasm around real estate, is because I think the reason we loved it 20 years ago, the same reason many firms love it, is it's just an enormous market, right?
Yeah.
It's not a monolithic enormous market. It's a collection of enormous markets.
Yeah.
Commercial, multifamily, hospitality, residential. But the why now piece I think is really interesting. And here's my thesis, which is there is an abundance of capital available right now in the venture ecosystem, driven by low interest rates, in part. And that's enabled funding of what's called these full stack business models, which is not just a technology platform to run a brokerage, but like a tech-enabled brokerage, soup to nuts. And that has really disrupted a lot of these markets in a way and faster than has happened in the past. And I think it's then forcing incumbents to adopt technology platforms to play catch up. So the market's opening up a lot faster. That's my thesis.
Yeah. And I would also say that if you look at two other fronts, there's some very massive companies been built in the recent 10 years, right?
Yeah.
Named Zillow and a few others. If you look at the portfolio companies of the various venture funds of the real estate tech companies, the fundamentals are doing really well.
Yeah.
Right. The number of them that are revenue generating 50 million, 100 million-ish, the velocity is just very, very strong. And then, so that's one aspect. I think the other aspect is just all of us sort of being sort of tech investors in the technology stack for a long time. As you look at the software that is fundamentally improving the customer experience, we all lease office, home, buy them, sell them. It's just you're looking for a better experience, and you just realize that, hey, there's actually quite a bit to do. To Patricia's point about the full stack, if you bring that full stack to the table, you could actually fundamentally sort of improve the productivity and really the customer experience of it, and hence there's just a lot of sort of investor interest in it.
Yeah,
I think 10 years ago you saw, technology. You saw transportation, food, real estate as kind of these big areas which no one really touched because you actually needed to hire people, and it was much messier than Instagram, right? So you've seen the world move to a place where those opportunities to have these very light digital media layer on top type of businesses are just lower. So people are more willing to do these dirty fingernail type businesses like real estate. I think for us, our eyes were opened. I was an early investor in General Assembly, and we were really kind of the first hot new next-gen co-working space in New York, and came to the conclusion you couldn't get venture returns on co-working. We were, clearly wrong in that regard. So ever since then, we've been...
Jason, time will tell.
Yeah. Well, I mean, the early investors could have sold the secondary and gotten a really nice venture return. But but I think millennials work, play, and live differently than ever before, which I think lend themselves to innovative operators coming up with different models that play into that.
Yeah.
I was just going to mention on the what Paul was saying about sort of innovating around the business, and I think it talks to sort of who are the customers, how are their needs different? Because I think in the past, business models have been pretty monolithic. The way you bought a residential home was the way you bought a residential home. And now there's sort of like new models that are catering to specific segments with specific needs, like the instant buyer. There's the trade-in. There are these different flavors that target different segments, and I think it's just much more. It's just leading to a lot of innovation, which is fun.
But there's also somewhat of a ability to forget macro cycles, right? So many of these models are dependent upon things not falling apart, and I don't know how much resiliency is built into some of these business models. So I think the first down cycle, we're going to know kind of, does the sheep have clothes or not?
Yeah. Well, certainly, I mean, we have an audience that includes a lot of broker owners here, and this has always been an industry where the cycles hit some people hard, and there are periods of really rapid growth, even very separate from venture funding, and then people get knocked down. But it's also definitely true that people have built really enduring businesses in this sector, and I do expect that we are going to see a number of really successful, enduring businesses built through the kind of fusion of real estate and tech as well. I don't think, one of the questions that we were exploring was, is this a bubble? And I think there may be ways that the answer is yes, but I also think that there are going to be ways that the answer is absolutely no. And we are going to see disruption in a whole variety of places that's going to be enduring disruption, because that's what customers want.
Yeah. I mean, on the question of is it a bubble? I guess I would say my answer would be, look, are valuations high? For sure. Are they high across the board in venture-backed businesses, regardless of industry? Yes. But is this a bubble in the sense of the emperor has no clothes? That I would say no. I think I would agree that I think there's real value being created. Now, I would expect some consolidation over time, right? Because I think we're seeing certain segments, or like, just take short-term rentals just as an example, right? There's a bunch of great companies getting founded there. I think over time, I think there'll be multiple winners. Will there be 20? Probably not, right? So I think there'd be some consolidation over time.
Yeah, and I also think, as you pointed out before, Patricia, we're going to see end-to-end business models emerge. And what I can say right now as someone investing as an early-stage investor in the space is we see a lot of people coming in and nibbling off little bits of the value chain, and I think you're going to see more and more kind of acquisition to almost piece together integrated systems.
And I would say the valuation bubble is all relative. I think the current expectation is that if you could be in part of one of the platforms that could be multi-billion outcome, then the entry price seems quite reasonable.
Yeah.
And we don't see that across the board right now. I think the valuation relatively is high, 50%, maybe 100%. But it's not like the ICO, some of the other sectors, or what's going on in Asia, where you could be 5 million revenue and you could be 500 million in valuation. I think here, 5 million, is still a reasonable it's still a high multiple, but I think the expectation is that it still could be a 10x opportunity from the entry price there.
Yeah. So what are the biggest opportunities you guys are looking at right now? Obviously, our audience is primarily in residential real estate, but what are the kind of trends that you're interested in around this space?
One of the things that we fortunately got involved recently is a company called Roofstock.
Yeah.
For those of you who don't know, this, the single-family rental home is, I didn't realize it's massive, 17 million homes in the States. Invitation Homes, certainly using their own balance sheet, has built a very, very great franchise there. Yeah. We realized, how do you actually have a platform where you could facilitate, right? That you can actually put a renter in there, produce an 8 to 10% coupon interest, and actually facilitate that whole marketplace to go. That's just at the beginning of what's to come. We're seeing people just want to own homes, even in slices of those, because think of it as a new ETF there. Yeah. So we're really fascinated by what is happening in that particular marketplace. The transaction volume is already very big, but I think we're just only really at the beginning of that trend there.
Yeah.
Yeah.
I think there's kind of we only at Mavron we only invest in companies that are creating consumer brands. So I think kind of within which eliminates a lot of the agent tools, SaaS businesses here. I think within our buckets, I think there's kind of three areas. There's financing innovation, which I think very heavy on capital, but there's clearly a lot of opportunity there. A second would be kind of UI, UX kind of innovation in terms of how you shop for a mortgage or renter insurance or things along those lines. And the third bucket, which is where we spent a lot of our time, is use of space innovation. Mm-hmm. We invested in a Sonder competitor building hotels on top of luxury apartment inventory. We invested in a business called Common, which is focused on co-living, which essentially is replicating in many ways the type of experience you have in a collegiate environment in cities as millennials wait longer to get married and want a more social environment. So we think you can get higher dollars per square foot by using spaces in ways that millennials want those spaces to be used. And then how that gets split between the owner of the building and the operator who's doing that varies, but I think we've been spending a lot of time in that area code.
Yeah, I mean, it's sort of interesting that I think for real estate owners, they've had this core asset called access that I think that they haven't really taken full advantage of yet. And I'm thinking in the multifamily world here, but where you've got access, you are the natural hub and gateway to services for your tenants, yeah. Which is a super interesting sort of paradigm shift, I think, in thinking about the asset that the real estate owner has. Just some of the themes that we've been investing behind. Another one is kind of this convergence of fintech and real estate tech. We've seen a number of business models where real estate services are almost being used as a loss leader and being monetized on the back end through financial services. So just as an example, there's a brokerage called Homey. We're not investors, but just they are basically providing discount realtor services. But they are monetizing through mortgage origination. We did invest in a company called Neighborly recently, which is providing kind of a world-class tenant screening app using machine learning. They're giving that best-in-class product away for free to landlords for tenant screening, and they're going to offer the option for renters insurance in the application flow. So they're monetizing through the financial service, and they're providing the real estate service for free. So I find that to be a really interesting trend.
Yeah, I think that affiliated services model where you're using brokerage almost as the Trojan horse to bring in a number of other different kinds of services is something we're hearing a lot about. And then I totally agree with you, Patricia, that I've been calling it home as sales channel, but this idea that you can actually meet someone at home on their couch and sell them services or different kinds of experiences there as their trusted partner, their landlord, their property manager. We're seeing more and more of that as well.
And also, in addition to residential, one area we're thinking about is so many e-commerce. Amazon has fundamentally changed the play of sort of the 2 days delivery expectation. As you see, all the companies, the storage, you look at what Prologis has done, where not many people pay attention to them. How do you have warehouse locations close to the consumption center? How do you actually close the gap of that last mile delivery and push the storage to really into the city at locations that people don't care about, right? Under the bridge, or that could be a really interesting play as you think about where the economy is headed and where all the e-commerce companies are actually looking for a new. At the end of the day, when we get stuff, has to still store someplace, right? And so, how do you that space? Not a lot of people have. How do you bring technology software into it that you could actually stitch that together as an alternative to some of the big behemoths out there? I think there's still plenty of opportunities there.
Yeah, and I think, to me, Paul, that also speaks to this broader trend we've been seeing around amenitization of the home, right? So I grew up in New York City, where I grew up in a building with a doorman. That doorman received our packages. We had someone who, there was a super if there was an issue. And I think you're seeing that type of servicing go deeper and deeper into the real estate ecosystem. And people really, and particularly millennials, want. Someone, when we did our prep call, described it as everything that mom would do. And I do think there's this whole everything that mom would do phenomena around home services right now. Yeah. Any other trends, particularly? We have certainly seen a whole trend around brokerage disruption, right? So whether it's the enormous amount of money that's gone into Compass, whether it's the amount of money going into Open Door, we were just talking before we came on about Fly Homes. Have you guys thought at all about that space?
I think there's an interesting thing which we look at as we're thinking about businesses, especially ones that interact with a lot of the big developers, your Hines of the world, where they work on a different time frame than venture investors. So you have this interesting situation now, both in multifamily and commercial, where you have a ton of cranes in the air, and there's pressure around. How many luxury condos can be built in New York City, right? So how do you differentiate those particular assets? But the time frames are so long. If you come up with a differentiated product and you need to design a building differently, that's not going to be opened until 2023. So how do you get that to intersect with a venture time horizon? So I think that's been a tricky area for us in terms of looking at that. I think the markets are so big, I think you need to get comfortable with, you might have 10 to 15 year time horizons to liquidity. And, there's certain VC funds who are comfortable with that and others who aren't. I think the other area is millennials don't want to own anything. So, what does that lend itself to? I think it lends itself to a lot of rental models, and it's everything from the surfboard you used to own to the couch in your apartment, and then thinking through how do you build those types of models without necessarily putting all of that inventory on the balance sheet of the company which you have. So this is very different than the Rent-A-Center or Abe's. I think this is fundamentally millennials living differently and enabling them to say, you know what, I want to have kind of French country decor in my apartment today, and I want mid-century modern tomorrow, and someone's going to just change it out for me.
Yeah.
And we've been noodling that a little bit.
Kind of like the rent the runway for furniture model.
Yeah. How can you make interior design turnkey?
Yeah.
Right?
Yeah.
'Cause it's not today.
Yeah.
But yeah, that sort of instant on, I think WeWork, to their credits, sort of spawned that mentality of, hey, why can't I just walk in? It's set up the way I want it set up. I've got the services available. And so will we start seeing that in other segments?
I mean, WeWork's so controversial. I'd love other people's points of view around. I think some people believe this is going to be one of the most important real estate companies of the next century, and other people believe it's a house of cards. I've vacillated over the years. I'd love other people's points of view around kind of where they sit in terms of WeWork.
I mean, I don't know much about WeWork. I think early days, I remember on the board of with Jared Kushner, and they were joking that they were arbitraging them, right? They were rented at $1 per foot, pack a lot of people in, call it a community, and charge $4 per foot. Classic for the one up there. But that was probably early days, was very, was cash flow positive early on. And then as the venture dollars sort of piled in, they went through a very massive expansion. If you walk into WeWork, we have two companies use them, that instantaneous sort of be able to walk in and get a space, not be committed to that long-term contract, right? That's some of the value part everyone in the audience understand well. It just speaks to a new community. It comes back to that customer experience.
Yeah.
That how painful it is to sign that long-term contract when you have to put, your equity dollars, sort of locking it up. So I think that sort of speaks to now. Over the long term, as they've expanded massively, hopefully they'll, I don't know will work or not. It feels like it's working, but I just think about that. How do you innovate on the customer experience? Right? We, being privileged to be involved with House on the board for a number of years, that's the same thing. To Patricia's point, it's so hard to find an interior designer, hard to find a contractor. Right? How do you consistently do that better? I really just think we're getting started on that particular front. I think about Compass a bit, where they've done a beautiful job serving community of agents.
Yeah.
Right? Like I just recently bought a place in New York. There's an agent I wasn't looking for a Compass agent, but agent had the Compass app, built that portfolio, made my life so much easier in terms of just sort of searching and remembering versus the traditional way of emailing me sort of ideas, and then I have to create a folder and save them. So that interaction to be able to say, hey, I like this, I didn't like this. That software, that simple software innovation, I think Compass has done a great job where I don't know if they would think about me as a customer. I think they would think about agents as a customer, and they've done a heck of a job innovating and attracting that community. So I think about WeWork and Compass, that target of community that they build, whatever that community is, I think matters. And then I think the other part is they've just innovated customer experience by at least 5x. So making them sort of breaking out. And as we think about more real estate investment, that's how we sort of focus on what's the community, what's the software stack in the middle that could genuinely sort of improve the customer experience there.
Yeah. My miscalculation on WeWork was that when they started, I thought of them as just a solution for startups. And those of us in the venture world, it's hard to build a big sustainable business on the backs of little startups because they are fundamentally, quick, they're not stable. My miscalculation was, in fact, the tendency at WeWork turns out to be a lot of large companies who have a couple of employees in a city and want a desk for them. And I think that gives them a much more stable base for growth. And this is the question, if there's a downturn, right, in real estate markets, is that a stable enough base that they can sustain what will likely be a high failure rate among the startup contingency of their tenants. And I think that's the question for a lot of these full stack companies, right? And the resiliency that you brought up, which I thought was a great point, is sort of like, are they built in a way that if there's a downturn, they have enough of a stable base of customers?
And WeWork could go both ways. I mean, as you move towards more of a gig economy, people might want a desk who are in a downturn as they move towards working more on their own. And it feels like big companies want more innovative workspaces, and it's clear WeWork is going to move in the direction of designing those types of workspace solutions.
Yeah.
So, I've gone from being cynical around this being just a arbitrage on stuffing as many people into a square foot as possible into you walk in there and they've created a real experience that's meaningful. So I think as you think through the future of work and how people are going to work and how you want to design work environments, I think they've led the way there.
Yeah.
It's interesting. I would just draw a parallel between WeWork and, in my experience, Open Door. When Open Door came into the market and they were really talking about targeting a segment who is willing to trade time for money, I was like, I think that segment is tiny. But now that they're getting their economics, like, it's less and less expensive to engage with Open Door as they become more efficient. I'm like, depending on the way consumer behavior evolves, I could see a scenario where Open Door takes a larger and larger portion of the market just because the transaction process is so seamless. And I think one of the things that we really, in this industry broadly, have to stay close to is consumer preferences are changing so rapidly.
Yeah.
And, it's not, people don't want what they wanted 5 years ago or even 3 years ago. They want what they want today.
Yeah.
And it's a unique point in time, too, because both the venture dollars and the debt are relatively free, right? Take Open Door, any of these companies, they've raised a lot of capital. So much of the processes behind the scene are manual, but it's okay in the time being because it's just heavily subsidized by the venture investors. So that's probably some of the things that traditional industry don't understand as well.
Yeah.
That just seems stupid. That ain't gonna work, right? But the truth is, yeah, you're right. It didn't work for the first 3 or 4 years. They manual process and they just work it. And if you look at the unit economics, you'd be like, wow, that thing is upside down. But there was a belief that with the data and the technology in there, once you automate it, at certain scale, the economics tips over very meaningfully.
I think it's such an important point, and one that's actually a nice place to end. You don't have to give venture money back. And actually, I think that,
We will like it back.
Yeah, we'd like it back. We'd like it times a couple.
Right, but
multiple.
But your point is right.
Like my dad, who has run for 30 years, a really successful real estate brokerage in New York, said to me early on with Compass, he was like, well, how are they going to pay the money back? And I was like, well, Daddy, they don't have to pay the money back. They're being paid to take risk. Yeah. Hopefully, they go out and there's some sort of exit event where their investors get the money back because they go public or there's some major acquisition. But, venture money is a much riskier form of capital.
But you are ultimately valued on a multiple of your free cash flow. So some of these venture companies don't understand that.
Yeah, at the end, you are, right? But, Great.
Eventually.
Yeah. Great, well, thank you guys so much. This is really helpful.
Absolutely.
Thank you.
Thank you.
Coldwell Banker's culture is unique because this brand has always been about the right things, focusing on the right things, growing agents, growing your business, and that's what's made the difference in my company and my success. I attribute much of that success to the mentorship, guidance, and support that I've gotten from the brand, and that is what sets this brand apart.
Please welcome Eric Brion with Vacasa, Colvier Tiger with Zeus, and Drew Otting with 8VC to discuss the new models that are turning residential properties into more than just a place to live.
Okay, guys, I'm just going to warn you that you're basically going to see me at every panel this morning, so get ready. Well, I'm excited to transition from that fantastic panel into this one because I think we sort of previewed a little bit of what we're going to be talking about on this panel with the discussion around the changes in the rental marketplace and the companies that you guys are representing are impacting that, right? So I almost wanted to start off by asking, like, what is it that companies in this space that we're talking about, this, property management, sort of rental disruption, I often think of this as kind of like adjacent to Airbnb. Like, what is it that they're doing?
Yeah, so from our perspective, it's all about bringing technology to what was always a very sleepy industry. So people, they do the basics in vacation rental management. They'd kind of make sure the house was clean. They'd kind of answer the phone if you called. But they weren't really doing much to actually optimize yields. And our focus on that is really creating a lot more opportunity around the investment side. I think both with the exposure from Airbnb plus the improvements in yield management, it actually makes vacation rentals a really interesting asset class for investors.
Yeah.
Yeah, I think it's interesting. When we started Zeus, we looked at the idea of densifying the space that we would take on. So I've seen a few startups that will take a 3-bedroom or a 4-bedroom and add a room and bring overall rents down. I've seen startups that are doing that even in the REITs, where there's a bit more vacancy than people would like. I've seen startups like us, which we're just trying to make the 12-month lease a thing of the past, provide a furnished unit, and provide convenience that way. So I think what's interesting is the economies of scale you start getting when you do this versus an individual owner, a bit of the emergence of brand and like higher amenities than an individual would potentially offer. And I feel like also there's a shift for millennials to want more convenience, basically. And so I think the startups in this space are trying to make it easier to find roommates, to have a community, or to just be more mobile by, having shorter lease lengths.
Yeah. And Drew, you're in a funny hybrid position at this table today in that you're both an investor who I know has looked at this space pretty broadly, and you're kind of here semi-representing Common, which Jason referenced as well. You two are both investors in Common. Do you want to talk a little bit about what Common is doing?
Yeah, I mean, Common is similar to, I think, just this broader trend. Common is looking to change the way that people think about residential real estate and think about, first, the idea that I think individuals living alone is not really something that historically throughout humanity has ever really existed. So this dramatic shift in the age of marriage and having children has brought along this decade or so in people's lives where they're potentially living by themselves, but they're also potentially living with a group of people that might actually feel like family, but that don't sort of have the traditional definition of it. And so what Common is doing is building a residential real estate product, which what I think actually is much more in line with the way humanity has always been, people living together and sharing space together.
Yeah. And just to be totally clear, because you answered more of my broad question than the direct question of what Zeus Living does. Yeah. I can explain because I'm an investor, but I'll give it to you too.
Yeah, so basically we provide corporate housing. So we're a startup version of Oakwood, perhaps. I think what's different is the way we approach this market was from the property management side. So the idea was if you have a property you want to rent out, you could come to the Zeus website, type in the address, we would give you an instant price quote, and if that was agreeable, you could just click accept, and we would rent it from you at that price there and then. And the value proposition is there's sort of peace of mind, you don't have to get involved in the day-to-day of the management, and we'll take care of the rest, and also higher quality tenants. What we would then do is we'd sign a lease on your property, we'd take over the management, we would furnish it and design it, and then market to corporates. So it's kind of shifting the business model a little bit on traditional residential property management. And we started about 2.5 years ago. We're in the Bay Area in LA. We have over 300 units. We've raised a Series A, and we're growing.
Yeah.
And just interestingly, I was looking at the data, but 75% of our residents are millennials.
Yeah. Yeah, so I think, I mean, Drew and I can probably speak to the fact that from the investor perspective, we're seeing more and more models of this sort that are basically taking assets from some player in the space. You know, Eric, for you, it's actually individual property owners generally, right, who maybe own a second home and have historically thought of that home as almost like a latent asset, but are now trying to extract a lot more value from it with a more, you know, active property management platform. You know, Kavir, you work more with landlords, and then I know Common is actually at kind of a point where you're thinking about how to most effectively scale the platform. Common initially was partnering with developers to almost like own and manage their own buildings, but that obviously is a more complicated process. Do you want to speak a little bit as someone who looks at a lot of this as well?
So as an investor, which is really, if I have authority on anything, it's that. You know, Brad should speak for Common, of course, but as an investor, I think, I mean, generally real estate is an unbelievably large market, and there have really not been lots of brands built in the retail part of the market in a long time. I mean, I think if you look at, like, you know, potentially Avalon, when they were smaller, they had a brand and they thought that way, but there's been a huge shift in hospitality where brand really matters.
Yeah.
Different parts of the market have different brands that serve them. It's kind of remarkable. And in every other part of, you know, consumer spending, brands have really driven a tremendous amount of value. I mean, it's funny, you probably have a toothpaste brand, right? But yet you don't think about the brand of the real estate you live in. It's very strange, and I think that's rapidly changing. I also think if you inject technology into it, well, I think that the physical realities of real estate have to be the first priority, but I do think that inserting technology into it as it leads to a much better experience as a consumer, but as an investor or an owner of real estate, it leads to a much more granular understanding of this asset, which is probably one of your largest assets. So it's a big focus for us.
Yeah, I think it's so interesting that, you know, brand is a key trend that all of these companies are thinking about, right? I don't know if you guys want to talk to that a little bit.
I'd actually take the contrarian view on that. So I think in many ways we are in a post-brand period here. Like, we're here at the Hilton. I made sure I didn't stay at the Hilton. There's trusted platforms, but we're looking for the boutique experience. We're looking for the micro brands. Now that you can get a review and actually see the interior of the actual space you're staying in, to me, that's what I'm looking for. And I think more and more consumers are looking to know exactly what they're getting for than just, well, the Hilton, it's going to be okay.
Yeah, but I think...
I would argue that that's just, you're just saying they have a bad brand.
Yeah. I think that's true and all. I mean, like, the JW is a great hotel, but I still don't seek them out. I'd much rather be at the boutique down the street. I think many people are looking for those unique experiences. Now that you give them the information to actually see those unique experiences, when you have the 3D tours, when you have the reviews, you're no longer just trusting Marriott as a brand, you're trusting the reviews on whichever OTA you're booking through.
So I guess one thing I want to ask you then with Vacasa, Eric, is clearly brand becomes important. Well, it's almost like it could be important on both sides or on one side, because you have two different customers, right? You have a customer who are the landlords or the owners of these assets, and then you have a customer who are the vacation renters. So yeah, being a trusted provider is clearly important in your relationship with the owner, but is what you're saying that it almost doesn't matter to the consumer if it's a Vacasa managed property as long as it's a beautiful, well-rated property in a location that they're interested in?
We see ourselves a lot like Amazon on that front, where you can buy a $10 toaster or you can buy a $300 toaster, but you know what you're getting. It shows up 2 days later. The process is simple. So we really focus on delivering on our part of the expectation. Is it clean? Was the process simple? Did you have a great experience? If you needed help, were we there for you? And then bringing transparency. So we do 3D tours of all of our homes. We have the real reviews from all of our prior guests. And so it's that combination that we give consumers. We have many properties that make a ton of money that I would never be proud to say are Vacasa properties. You know, that ski-in, ski-out place at Squall with carpet from the 80s and stuff like that, because we are very dependent on our homeowners. Yeah. But there's people out there who, they're looking for the ski-in and ski-out, and they don't really care about the carpet, so that's the home they want for that trip. A different person would stay far, far away from that home, but we're giving them that information to make that decision.
And what they know if they go via your platform is that the pictures will be accurate, the property will be clean, it will be well managed. Yeah,
exactly.
you obviously, you have a different approach, Kabir, I know.
Yeah. Yeah, I think we do try and somewhat standardize the interiors and introduce branding into the property so people know they're staying with Zeus. I think in our world, I agree there's definitely a movement away from like the more cookie cutter corporate housing places. So people really value that they can stay in a home and they can stay in a neighborhood where maybe traditional corporate housing isn't present. And so we see a lot of that feedback, and then often we'll hear, once people have stayed with Zeus and then the amenities and services we provide, and then they'll go elsewhere, once you've given it to them, it's very hard for them to get used to like not having it again. Yeah. But yeah, to that point, I've definitely noticed people want to live in unique places, unique homes, and in different neighborhoods to what's usually being offered to them in the corporate housing world.
Yeah, so another interesting thing about all these models is they're software-driven models, which means that you actually have an incredible access to data around what's happening both on the consumer side of the business and the costs of managing these properties, a lot of consumer preference data. This is a really important part of what you guys are doing. Can we talk a little bit about that?
Yeah, so at Vacasa, we use data in two major ways. The first is all around our yield management, our optimization, getting every home booked as much as possible at the highest possible rate. So that's something that's extremely dependent on data and something we're very focused on. We also use data a lot on the operational side. So we are an employee-based company. We have 2,500 employees. When we clean a house, it's one of our employees doing it. But at the same time, we manage that almost like a gig economy company where we have algorithms and systems that look at, well, what's the efficiency of this housekeeper? What's the effectiveness of this housekeeper? What else are they cleaning that day? What are the local labor laws? What other cleans are they doing that day? And it automatically generates that route. So it's not just what was typical in our industry of, hey, so-and-so is my favorite housekeeper, so I'll give them all the work. Yeah. So there's on both sides of both operations and revenue generation, there's just huge potential for data.
Yeah, Kabir, we talked about this a little on the phone in a way that I think is very interesting for this audience. Data around tenant screening, who's perhaps the most interesting tenant, and then around things like the cost of property management and even the impact of, this house has a marble bathroom, this house has a tiled bathroom. What's the differential in what I can charge for that?
I'll start with the second point. Something that we think is really interesting is eventually being able to price up the value of installing a digital lock. Because we can do that on some properties and some we can't. And then over the course of a year, 2 years, 3 years, the amount of like lockouts or people losing the keys, and actually pricing that versus the digital lock, it becomes quite interesting. And then you can apply that to many other aspects of living in the house. And then I think what's interesting is we can see a property, we can judge the age of the appliances, when was the carpet changed, if there was carpet, and then we can literally say, if we replace the carpet or we update a couple of the appliances or paint a wall, it's going to increase yield by this much, and introduce efficiencies there. And I think previously for an individual owner, that kind of stuff feels a bit risky. Like if I invest in this rental property X, is it actually going to pay back for me? But we can actually show the data there and maybe even someday finance it for them. And take care of the actual work as well. So I think that data to me is personally really exciting. And I also thought from an investment point of view, everyone looks at NOI and these other things, but actually differentiating the operational costs, exposing that data to investors, I think could be quite helpful. And on the first point on tenant screening, we've done maybe approaching 2,000 leases, I think, and we've had 1 formal eviction and 2 where we sort of settled with the person. And it's been interesting just learning actually what is the right level to set the credit score sort of check at. And then other heuristics, sort of joke, if someone's, I think at the eviction that we had, if someone's looking on a Friday to move in on a Saturday and they're quite pushy, it's not going to work out. And then in the summer, we have intern season, and the other thing we learned is if there's a helicopter parent booking the kids, those interns aren't going to be well behaved. And we've seen patterns like that, which aren't obvious up front, and I think that's interesting.
Yeah, I think it's a really important point for us as the residential real estate industry, though, because as people get more and more used to this type of adaptation to them as renters or as vacation home owners, and people are going to expect this more and more on the residential sales side of the business as well.
Totally. I mean, it's for the average person, whether you own hundreds of properties or one property, it's going to be the biggest asset that you have, right? Whether you're a billionaire and you have a $500 million real estate portfolio, or you're one person who owns one home, it is going to be, for most people, the largest asset they have. And so the idea that it is both managed, bought, sold in a way that doesn't use data, when you can. The way that you would sell a stock or something on E-Trade is all this information is kind of ridiculous, and I think that's going to massively change. I think it's especially true on the property management side. If you're a third-party individual managing someone's asset, you need to start thinking of yourself the same way that someone who is a steward of someone's wealth through stocks or bonds or anything else thinks about it. You need to think of that level of fiduciary duty and of data if you want to be well-positioned going forward, I think.
Yeah. Let's just talk very quickly, guys, about lease terms and the way this sort of changes the standard way we've thought of people being willing to sign up for 12-month leases or to even just leave their vacation homes fallow. This really represents a shift in the way that people are thinking about this.
Yeah, so I think starting with the supply side on our landlords, we started off offering 12-month leases. We were just generally nervous about what's happening in the market. Is this going to work? Over time, we've extended it to 2 years. And then I think as our confidence goes up and our understanding of the economy goes up, then maybe it'll be 3 years, 5 years, 10 years. I don't know.
So I just want to clarify so everyone understands. You're taking those leases over from the landlords, but then what you're offering to the consumer is very different.
Yeah, and then on the consumer side, it's almost 100% flexible. You can pick any start date, any end date. You can be month to month. You can extend on the fly. And I think, we've seen certain people who they get their relocation, they'll stay in Zeus for a couple of months, it's time to find a long-term place. It's a bit of a struggle, then they'll move into another Zeus place, check out a different neighborhood, then that lease ends and they want to find a long-term place and it's a bit of a hassle, and then they'll just end up booking with Zeus for a year or longer. So I do think maybe what we're calling corporate housing today, or what's offered in corporate housing today is just what regular renting looks like in the future. Yeah. And there'll be various flavors of it, like Common and Us and so on.
Yeah, I think when you talk about co-living or community-based living, there are these very basic things that, for whatever reason, traditional landlords and property managers tend not to like. So the idea of signing a lease to a bedroom versus a lease to an apartment, very fixed 12-month leases, the way security deposits work. These are all things, this isn't rocket science fixing this, but you can imagine if I live in a group with a bunch of individuals, some of which I may know, some of which I may not, all of whom are on different life paths and different life schedules. Do I want to be signing a lease with all of them over 12 months and have a security deposit that we share? Or would I rather just take risk for myself? So these are pretty basic things, but you can't do new models of real estate unless you think about the lease terms and the friction that causes the tenants that you have. So I think that's 100% a big part of the.
Yeah. I do just want to wrap up by asking, we have a number of real estate agents and broker owners in the audience. How should they be thinking about interacting with these type of models, if at all?
Yeah, so at Vacasa, I think there's just so much potential actually, a lot of you should put money to work in secondary homes. A lot of you already have them. They're probably sitting empty. You're right here at the Hilton, and you have a beautiful home on a beach or a mountain somewhere. So that's one. But just generally, I think it's such a growing segment where people are looking to diversify. They're thinking about, it used to be, hey, you wanted a rental so you'd buy a fourplex. Well, it's a lot nicer to own a ski condo. And you can get similar cap rates. So a lot of it's actually, I think, personal for those of you not in these markets, just as the potential.
Yeah. And do you, Eric, are you, let's say, we have realtors from Aspen or from, the beach here. Are you working in partnership with them to offer this service almost like at the point of sale of the home? Or because this could be a key thing for people making decisions as well, right?
And thank you for working so hard to give me my free pitch there, which I was for.
Well, it's really, I think of my own agents in New York, and sometimes, New York is a big secondary home market as well. Sometimes this is a big decision factor for buyers.
Yeah, for us, we're partnering with agents, the leading agents in markets across the country, to help people find the right vacation home on the buy side. So we've grown to be the largest in the US at vacation rental management by convincing people to give us their unused home, or by convincing them to drop their existing manager, stop managing by owner, and come over to us. But historically, we've totally missed out on the buy side, where people are thinking, hey, I want to buy a home and I have that rental intent. We have great data to help them figure out exactly which one. We know the regulations, which markets are the safest to buy in, and we have an interior design team that can fully furnish that home, everything from the furniture to the silverware and the linens. So there's a lot we can do to partner with agents to help find the perfect second home for people.
See, that actually is.
Thanks for the few chances.
Great. Well, we've run out of time. And guys, it's great to talk to you about this. Really informative, I think, for everyone. Thanks.
Thank you.
We don't adapt to change, we create it. We form connections that help us to innovate and to stay ahead of the real estate game. We are community and team supporters, and we find ways to win and win big. We believe that our core values of collaboration, innovation, diversity, and growth are needed now more than ever, and they have enabled us to evolve into technology warriors and solution architects. When you succeed, we all do.
And now, for a rare look inside SoftBank's real estate investment strategy, please welcome Justin Wilson with SoftBank.
Wow, you got the...
What interesting music.
I'm going to make this that, so...
You'll grab these two?
Yeah, let's just get over. That's quite a way to come in. So this is actually one of the discussions I've been really excited about for today, because I think that your involvement as a representative of SoftBank in the industry really has the power to meaningfully impact what happens in the industry over the course of the next 5 to 10 years. So understanding what you're thinking is really exciting for me and hopefully for our audience as well. So I wanted to begin, for those who don't know, by asking you, what is the SoftBank Vision Fund and why does it exist?
Yeah. So probably 18, 24 months ago, I didn't really know much about SoftBank, right? I suspect most people here didn't. Yeah. I actually joined 3 years ago, so really it was 3 years for me. But SoftBank has been a fairly prolific investor, investing in technology. Masa's an entrepreneur. It's a Japanese company. And he's really made a career out of pushing the boundaries on the information revolution. So he's had conviction around the trajectory of multiple industries and the application of technology and innovation for decades. Probably the most famous investment that SoftBank has made was back in 2000, putting $20 million into Alibaba, which is now a $500 billion company.
Yeah.
And that has continued through the years with investments in Sprint and Supercell, just all sorts of technology companies. And the Vision Fund is just the most recent incarnation of really executing that same vision, but with a much larger capital base.
Yeah.
And I think that's really what's captured the attention and imagination of the industry.
Yeah, so let's just lay out for people, the Vision Fund is a $100 billion fund. And I believe it's Sequoia who had the next largest fund, right, at $6 billion. So it's a truly different scale of capital that you guys have to kind of leverage to partner with or help to evolve an industry.
Yeah.
And just tell us a little bit for context about who you are and how you ended up at SoftBank, and also why you've ended up being the person who's operationally involved in so many of SoftBank's real estate investments.
Yeah, so I joined SoftBank about 3 years ago before there was a vision fund, but again, we were still doing very similar late-stage investments with the same vision. Prior to that, my background, I spent a number of years as a sales executive and a strategy executive at Google. Pretty long stint at BCG, which I know you were also at, really working with consumer and technology companies on all sorts of growth topics.
Yeah.
But the common theme throughout all of that has really been that combination of consumer and internet and technology in my career. And so when I joined SoftBank, seeing the passion of the organization, the commitment to investing in really innovative technologies, that was just a really exciting opportunity. And as far as my own interest in how I got involved on the real estate investing for SoftBank, it's been a bit of a passion area personally for years, right? My dad was kind of the consummate home repair, home do everything in the house. I remember being on my hands and knees laying tile in the bathroom, replacing faucets and doing all sorts of renovations. And so there's always been this element of just feeling a real attachment to home and real estate. And it's just been an area that has been a personal interest. And then as the Vision Fund kicked off, and I think Patricia mentioned this, real estate as an industry is just enormous.
Yeah.
Like the market size for, it's $230 trillion of assets globally, which is larger than $170 trillion of securitized debt and equities. So it's this enormous market, and every segment across the ecosystem has that size and that potential. And so it was an area that, as we talk about SoftBank's $100 billion fund, we almost have to be playing in that space, given how big and meaningful it is.
Yeah. Do you guys have any, would you say that real estate is sort of a core interest of the fund, or,
It was never stated out to be that way. It wasn't like, let's go big on real estate. I think what you've seen through WeWork and Compass and a number of other investments, it's certainly taking up a pretty meaningful share of our capital. But there's no hard and fast rules which it needs to be X%. I think real estate is 17% of GDP, so my view is it should be at least somewhere around that size and scale, but there's nothing internally saying it has to be bigger, smaller, or exactly what it is today.
Yeah, but that one of the reasons why I was really excited to talk to you is that that's a really meaningful amount of capital if you were to deploy that much capital in the sector over the course of, let's say, the next decade. That really has that could meaningfully change the industry. And you mentioned that you guys made this big investment in Compass. You sit on the board of Compass. Do you want to talk a little bit about Compass and what was exciting to you about Compass and the opportunity in the brokerage industry?
Yeah, I think Compass has a really phenomenal vision. I think that they're really going to be a huge innovator in this space, and I think that they're really transforming the industry as a whole. They have a obsessed focus on really building these technology tools and building the capabilities, ingesting tremendous amounts of data. Kind of all through this week, I heard from Gary to Patricia to all sorts of folks talking about the importance of data in real estate, and that applies for every industry we're looking at, but certainly in real estate, being able to leverage data in ways to improve the consumer experience, to improve the cost structure of businesses, to improve agents' lives. And I think Robert's vision was one that we felt very strongly by as we got to know him and the team. And when we come in and we do an investment, we do a tremendous amount of diligence, especially with the checks that we're writing. And I think one of the things that was telling was, we did surveys with thousands of buyers and sellers of homes, and I think there's this false narrative sometimes in the industry around, agents aren't bringing value, they're getting paid too much, like why are they doing what they're doing, and the whole thing's broken. And I think at least from a consumer perspective, what we found was people find tremendous amounts of value from the relationship with agents, and most people want to go and recommend the agents provided they had a good experience to their friends and families and coworkers. And so some of what we saw there just didn't match up with some of the narratives that I think are commonly thought of when we think about residential brokerage. And so seeing that in the work we were doing and seeing the vision and mission that Robert and the Compass team had, it just seemed to be a great alignment.
Yeah. Can you imagine making other investments in the sort of residential brokerage space more broadly? I mean, we've talked at the conference about the idea that there could be a few different levels of service.
Yeah. It's going back to the first point, it's such a huge industry, right? I think there's $7 trillion of turnover in residential property annually globally.
Yeah.
In the US alone, there's 80 to 100 billion of brokerage commissions. And so it's a huge industry that has these slices, and I heard your pyramid and your 3 slices, and there's different variants on that. But I do think, and this again proved out in what we analyzed and the diligence did, there's different needs.
Yeah.
Consumers have fundamentally different needs. They're buying and selling homes for very different reasons. And I think what we're seeing is a lot of models emerging to really target the pain points and the needs of those consumers. And so I can see there being a number of players that deliver tremendous value to consumers over time in that space.
Yeah. And, with the checks that you're writing, you bear an enormous responsibility because, on our prep call, I used the term kingmaker, and you pushed back and you said, well, I think we're a prince maker at best, which I think is really a way of saying that you feel like you can only back the people who are themselves going to be able to make themselves king. But it is true that you have the power to meaningfully shift industry dynamics. Yeah. How do you think about that?
Yeah, I think that's, first and foremost, we do look to invest in market leaders who have a great vision, a great set of entrepreneurs, a company and a vision that we feel like capital is going to be one component to the recipe for that company to be ultimately very successful.
Yeah.
With that said, there's no question that capital is an advantage, right? And there are industries where, particularly in upstart scenarios where there's a number of players and some of the more well-capitalized players early on have the ability to attract some of the best talent, make investments into whether it's technology or scalability or really anything that's going to allow them to be kind of break away from the rest of the pack. And in a lot of industries, you have these winner-take-most dynamics where once you start to emerge, you just see kind of that flywheel and snowball effect where it just builds and builds because there's so much value. And that's the classic, Facebook. Why are you on Facebook? Because everyone's on Facebook, right?
Yeah.
And so I think capital can certainly be an advantage. And I think we know that. But it's also not what we think SoftBank, it's not the core thing we bring, right? It's what's talked about the most in the media because it's this huge $100 billion fund and we're writing billion-dollar checks. But what we actually think we bring is long-term patient capital, alignment behind founders and entrepreneurs that have these hugely disruptive visions. We think that our DNA, we tend to talk about globalization and internationalization in a much bigger way than I think most investors do because our DNA and our heritage is as an international organization.
Yeah.
And so the relationships we have, the investments in Alibaba, Yahoo, Japan, we have one of the largest enterprise sales organizations in Japan. We've helped WeWork to kick off and run their JV in Japan. So we have these assets in place as an organization that allows companies to go global. And so we think that it's actually that alignment of vision supporting the entrepreneur and our capabilities on the global stage, which is actually what's attractive to founders in terms of working with SoftBank. Yeah, the money's nice too.
Yeah.
They're not going to turn that away, but it's one part of the story.
Yeah, I do think though it's an important point you made about the patience of your capital in terms of just when we were talking at the very, I was talking to Patricia, Paul, and Jason about the venture model and the fact that it's not money that you have to give back, per se, that usually there's some sort of exit event or liquidity event that returns money to investors. But you sort of extend the timeline a lot of the time for that to happen. So historically, it might have been that someone felt a lot of pressure to go public in a certain time period. Yeah. But with your partnership, that maybe isn't as much of a pressure.
Yeah, that's right. Though we're not, we're in this with LPs to also make a financial return over time.
Yeah.
Well. So it's not that we're going to invest and hold forever because that model doesn't work. But I think we are very aligned in our vision and mission to support entrepreneurs and backing what they believe the right outcome is for the businesses. Yeah. And so if that means staying private for a period of time, being able to invest in growth in a way that the capital markets may not necessarily understand or reward a company for, then that may very well be the right path forward. And whether that's a 3-year, 5-year, 8-year time horizon of being private, we're perfectly fine with that. Now, with that said, we're not going to discourage a company from going public if that's the right answer for them. Yeah. And in instances, and again, I'll go back to Alibaba. When Alibaba went public, it's not like we liquidated our position. We actually thought that Alibaba as a business and as a platform had such tremendous potential that we ended up holding on to the entire position for years, right? I mean, we could have made a tremendous return at IPO, yeah. And we still have a vast majority of the shareholding that we originally did.
Yeah. Any other trends on the residential real estate side of the business that you're looking at now that you think are kind of interesting?
Yeah, I think this has been alluded to on the stage as well. When we look at businesses, we want to find opportunities of companies that are really leveraging data and extensively in everything that they're doing. And we want to invest in platform businesses that have the potential. And again, some of this is the stage of investor that we are. When we're putting $100 million, billion-dollar checks to work behind these companies, they have to have the potential to be very large businesses. And being a platform business, which allows them to take advantage of not just one piece of the value chain and opportunity, is something that's very attractive. Going back to Compass, I think that agent relationship is so powerful. There's so much trust. They're really a partner through that journey for a home buyer, a home seller. And that trust is given over and earned through the period of that relationship. But I think a lot of times people see that, well, great, the transaction is done, and maybe I'll get an email once a year, and that relationship starts to distance. And so our view is going from a place where you have just such phenomenal connection and trust, that's very hard to build. Yeah. And so looking for platforms, and we think Compass is one of these platforms, which is going to be able to leverage data and technology to be able to take those relationships and empower agents to continue to monetize and sustain those relationships with consumers over time. So data, platform, scalability. I think over the last decades, we've also seen what has been a very local experience because of where data is held, where relationships are, where knowledge is. First, you saw the democratization of that information, where everything in MLS went into Zillow and into Trulia and to Redfin, and now all of a sudden consumers have all of that at their fingertips. And then you started to see some innovative business models emerge on top of that, right? Compass and Airbnb, that's not in residential, but it kind of plays in there.
Yeah, it kind of is.
And so you're seeing some of these innovative business models start to get built on top of that. And so I think we're going to continue to see that evolution play out from what was very local at one point in time to greater scale because of that democratization and access to data, which is just enabling a lot of things to happen that you wouldn't have been able to see before.
Yeah, and I would say, just to that point about Airbnb, I think when you have Eric from Bacasa sitting here talking about how they're starting to use their data to help real estate agents sell buyers on a vacation home as an asset that they can both use as an investment asset and as, like the pleasure of having a place by the beach. You really do start to see that synergy of, these platforms that maybe we thought of as being hospitality or property management platforms creeping in closer and closer to the residential sales process. Yeah. So we've also talked a little bit about the affiliated services and brokerage increasingly becoming a channel for different kinds of services. Another investment that you've made is in a company called Lemonade. And I think Lemonade is a really interesting company as well, but one we've talked less about than Compass at this particular conference. Do you want to talk a little bit about Lemonade and the emergence of these disruptive companies in the affiliated services space?
Yeah, so I'm less familiar with Lemonade, not an investment that I led, but as a firm, I think, and looking into the ecosystem, we are seeing a lot of these examples of models where that relationship is the door opener into other transaction models. Again, Patricia was talking about the financial services industry and fintech, where you are leveraging those relationships and then monetizing in other ways. And we've seen mortgage originators start to move into the brokerage space and acquire brokerages in order to really help that business, where they're thinking about it from a fundamental different monetization perspective. You have businesses like Lemonade, like Hippo, like there's a number of them, whether it's in insurance or property insurance, title and escrow, like all of these pools of opportunity, which are in their own right multi-billion-dollar opportunities. And so I think we're seeing a lot of that start to play out, where you're finding players that are increasingly verticalizing and trying to create full stack solutions, not necessarily because like, hey, we want to go out and build a full stack solution, but because they're finding that maintaining those relationships through that life cycle of a consumer is providing opportunities for them to acquire customers, but then monetize them in multiple ways over time.
Another investment, and actually I know you're more directly involved in this investment, that SoftBank has made in a very meaningful way is into a company called Katerra. Yeah. And I think Katerra is also a company that we in this room should all be aware of. Do you want to talk a little bit about what Katerra does? Yeah,
Katerra is very different from obviously a Compass. And Katerra it's a technology-enabled construction company. Yeah. Which is not very glamorous and sexy, and it's not what you tend to see splashed all over TechCrunch. But what they're doing is wildly transformative, and construction's another subsector across that real estate ecosystem that we look at, which is $10 trillion of annual spend. And it is a broken process today. You effectively have a very disjointed value chain of developers that are going out and finding land and then trying to work with architects and designers, and those architects and designers are going back and forth, and they bring in a general contractor that's going back and forth, and the general contractors are bringing in subs who are then going to Home Depot and other wholesalers to acquire product, and there's no technology and there's no common record to kind of make that all work, aside from these massive reams of plans. And Katerra is trying to rethink all of that. Like, how do they build better, faster, and cheaper? And they're doing that in three ways. One is they're verticalizing the supply chain. So Michael Marks, who's the CEO, was the former CEO of Flextronics, and that's what he did in the electronics industry. Yeah. He basically said, look, like, why is there all this waste, and there's 5 middlemen before the end product gets to the site? And so Katerra is verticalizing the supply chain, going direct to manufacturers. They are industrializing and using robotics and automation and technology to create some of the buildings and factories, floor panels, ceiling panels, wall panels with electrical and plumbing and windows, everything already in there. So when you go to the job site, you can just kind of attach these things like Lego blocks almost. Yeah. And that's so important because the industry is one that has, over the last decades, not seen the type of productivity uplift that manufacturing, logistics, telecommunications, internet, everything else has seen. They've been stagnant over that period of time. Yeah. And so there really is a need, because of our aging demographic and fewer people going into the trade. We're seeing supply shortages of housing here in the US and all over the world. Yeah. So they're solving a really important problem on trying to deliver things on a 20 to 30% cost discount to construction today, on a timeline that's 40, 50% shorter than construction today.
It's a truly transformative product, just in terms of pricing and delivery time. And can you remind me, their last round was they've raised more than $1 billion, right?
Not more than $1 billion. I think they
800
have over
million?
time. Yeah, it's around
Yeah.
that amount.
So just again, to think about the type of investments that are being made into these technologies that truly could transform, particularly urban construction.
And that's one of, we think, the benefits of a platform like SoftBank, and with the check sizes we have, there aren't a lot of players who've been willing to go in and write a $500 million check to innovate in construction.
Yeah.
Right? And it's an extremely capital-intensive business, and you need someone with the conviction who's going to be bought into the vision of an entrepreneur to say, look, this is a massive problem. This is a huge global problem, and we're trying to solve it. We're bringing technology. We're creating an integrated technology stack. Like, those are things that aren't necessarily easily funded, and they take a very long time because you're doing everything in an incremental way. And so when we go and we talk to entrepreneurs, a lot of these large checks are born out of, if capital wasn't a constraint for you, and you could go build this business and create this opportunity, like, how would you think about your business plan differently from today? How would you invest into the business differently today? And that's a pretty common theme for a lot of the entrepreneurs we talk with, and they get really excited about that potential.
Yeah, it's very cool, Justin, to be able to give someone a ticket to the moon. Well, thank you so much for being here. I really hope we'll have an opportunity to have you back in a couple years and see how what you've been investing is changing our industry.
Thanks so much.
Yeah.
Their clients or their prospective clients. They just want to have a geographic area where they're hammering again and again. And then there are others who they will only do something if there is a lead generation component to it. So we want to be able to understand what their needs are, get them onto the right platform so that they can get the right expectations from it. But you really need to talk with the agents to find out what they want to get from their marketing. And for those folks that it is pure lead generation, going back to what we earlier talked about, they have to understand what these leads are. And if they have a better appreciation for it, they're going to have more success and they're going to be longer term clients with us.
Yeah, and I mean, I would say to the audience that I think we have not been such savvy consumers of these products historically, and that actually it's going to make the whole industry better for everyone if we push harder about what's the ROI, what am I paying for. You know, I love that parallel you're drawing, Ben, that if you're paying a 20% referral fee, the conversion should be well more than 20%.
Yes.
Yeah.
But the agents, they really need to track that part of it. And I see a lot of teams doing a really, really good job of tracking their ROI, individual agents not as much. So I think we'll probably see more teams because they can handle these leads better and have a better understanding of what that true ROI is.
Great. Well, thank you so much, guys. Sorry we have to. This was great. And yeah, look forward to talking to you again soon.
Thanks for having me.
Yeah, thanks for having us.
Yeah.
Yeah.
When you're buying and selling a home, there's a lot of ifs. There's a lot of things that are beyond your control.
At Knock, we change all that by buying your new house first, moving you in, then taking care of your old house so that you don't have to live in it while it's being repaired or shown.
Life doesn't rearrange itself around the timing for you to buy and sell your house. So we're trying to give you the opportunity to rearrange the buying and selling of your house around your life in a convenient way for you.
Find out how much your house is worth today for free at knock.com.
A new breed of companies is redefining what it means to own your home. Please welcome James Riccatelli with Unison, Sahil Gupta with Patch Homes, Adina Heffitz with Divvy, and Fabrizio Tiso with Irene.
Please, thank you.
Appreciated the applause again, guys. We're nearing the end. But this is another panel I'm really excited about because it's a topic we touched on when we talked to Patricia, Jason, and Paul at the beginning that I think is a really important trend in the residential real estate space broadly. So maybe we can just start off with the question, what is the shared equity economy?
I'll start.
we prefer to think of it as the shared outcome economy. It's partners coming together to accomplish a financial goal where they can produce a result better than they could singly, and they share the outcome by the change in value of the property.
Yeah.
So what we do is we provide a lump sum of financing. It can be used to purchase a home as part of the down payment. If you already own a home, you can use the money for any purpose. It's an alternative to tapping into your equity with a home equity line of credit or something like that. You can use the money for up to 30 years without making any payments to us because it's not a loan. There's no interest. And we share the outcome. When the consumer sells their property, if the value of the property's gone up, we take a piece of the appreciation as a profit. And if the property value has declined, we actually share part of the loss as well.
Great.
Yeah, the way we we think about the economy really is it's about empowering homeowners, consumers really with a variety of choices, right? How do you get a financial model where the consumer can access the equity, but at the same time, there are aligned incentives between the consumer and the financing partner? Because long term, if you have your financial incentives aligned, it leads to better outcomes. And at the same time, you are empowering these same homeowners to actually better utilize and monetize their asset. In fact, the largest asset they ever own, which is their house, without adding more debt, without adding more monthly payments to them. So our model is similar to what Jim said, where we allow existing homeowners to pull equity out. And in return, rather than charging them an interest or a payment, we share in the future risk of home values. If they go up, we all win together. If they go down, we all lose together.
Yeah. So just to be totally explicit to the audience, basically what we're talking about is products that are alternatives to mortgages or home equity lines of credit, at least in the case of these two businesses, where the company basically owns a share of your home and participates in the outcome with you. Right?
Yeah, with us, just to add one thing, thought to that, with us, it's not just an alternative to a mortgage. For an existing homeowner, it is.
Yeah.
But for someone who's buying a property, we're additive to a mortgage. In other words, you use us as part of the down payment, which makes it easier to qualify for the mortgage or increases your purchasing power because we turn a 5% borrower into a 20% down borrower.
Yeah.
Or a 10% down into a 20% down. And what that does is it eliminates mortgage insurance and lowers the monthly payment by 20 to 30%. It can increase purchasing power by up to 100%.
Yeah.
And I think that the model actually varies across probably all of us a little bit. So you have things like Unison where it's a set amount of the home that they own and it appreciates with the house. With us, with Divvy, you're actually building equity every single month. So your fraction or percent ownership in the house actually is changing real time every single month, and so you have sort of your own equity cap table in the house. So the models tend to vary. You either share equity once you already have it, so with like Irene, where you can cash out your equity position, or you help share it at the beginning when you're just starting to build up.
Absolutely, and I think a lot of these options have generally been available at the institutional level, in commercial real estate, in public markets.
Yeah.
And it's all about bringing that level of choice to the mass consumer space, essentially.
Yeah.
And what I think it's very interesting to see is across different models is really the way I think about the shared equity is almost like a storm of new companies and models where fundamentally challenging one thing that has always been considered a truth, and is either you own or you rent. And all of us at different point in buying your first home or access some of the equity, or in our case at the very end of the life when you end up in retirement, having all your assets in their home, we help seniors get a better use of the home equity to finance retirement. But we're all fundamentally challenging that either you rent or you own.
Yeah. So there's an element of this that I'm almost like, it sounds like it's too good to be true. Why do you think this is happening now? What do you think this is part of more broadly?
I think a lot of it really has to do with the shifts in the macroeconomic and the demographic of the US economy, right?
Yeah.
If you've seen the last 10 years, we've had a massive shift in the way people work, the way people earn, the way people live, right? And what that has now led to is you have this weird dynamic, especially in the consumer space, where you have asset inflation going off at 6% a year, right? Home prices, all across the country. At the same time, say, wage inflation, or the way our incomes are growing, is about, say, 1.5% to 2% a year. And that's creating this massive gap between people feel they are rich on paper, because the house is worth $1 million, but they can't make a mortgage payment or they can't make a credit card payment. And it is about bridging that gap between cash flow of the house and cash flow at a personal balance sheet level. And I think that is where this trend makes that much more sense today, because like people are really hurting from a cash flow perspective. And I think these are shared economy models, with Divvy, with Patch, with Unison, Arene, they are helping people bridge the cash flow gap essentially. So that's a big reason why we are seeing a tremendous amount of interest in the model today as compared to, say, like a decade ago or even further back.
Yeah. And I think what you're kind of hinting at, but maybe just to be a little bit more explicit, is we saw prior to the recession, for 50 years, the rate of homeownership increased, and that increased to about 69% of homes today being owned rather than rented. And then post-recession, that dropped down to probably about 63%, and today has jumped back up to about 64%. So people aren't owning homes today, and it's either one of two reasons: either you don't have the equity down payment, or you can't get the debt piece, which is the mortgage. And so all of us in some way try to create increased flexibility, mostly on the equity side, rather than just pushing for loosening credit or mortgage underwriting requirements.
Yeah, I couldn't agree more. And when you think for the retirement space specifically, comments about flexibility is really what we are. And I think that when you mention like why now, in the retirement space specifically, I think that the rise of new equity model is inevitable and is going to operate really fast, because on one side you have all that Sahil was saying, but also you have 2/3 of older adults who are not prepared for retirement. And by using home equity, they could increase their retirement income by 40%. And on the other hand, you have the two traditional ways to access home equity as an older adult, which were selling and reverse mortgages, which are becoming less and less appealing. It's a massive mega trend of want to age in place. Reverse mortgages are at the lowest level for many reasons in 15 years. That is not leaving a lot of options to seniors. And so I think it will be inevitable to see more flexible models that leverage the equity in the next years.
Yeah.
A couple of other points on that, in addition to the things which I agree with what everyone else is saying here. You've also got student debt. You've also got situations where the parents of the millennial generation are not as prepared to help their children with a down payment as previous generations were, because the savings rate has gone way down from what it used to be. So it's kind of a perfect storm for the poor millennial generation. They're fighting debt, stagnant wages, prices going up. They don't have the parents there to help them out. A lot of them are unfortunately faced with making choices that are really hard choices to make, like, can I have a child or can I become a homeowner? It's not, can I do both anymore? So people still want to accomplish these lifelong ambitions, these goals, and by using equity, you can add to the system and enable those kind of things.
Yeah. So you mentioned, Adina, the recession.
Yeah.
And I think with models like this, we've certainly seen the negative impact of mortgage debt on both the economy and personal, consumers themselves. What sort of risk is involved for consumers in these models, and how do you think things are going to sort of even out in terms of the balance of debt and equity over time?
Yeah, so I think the risk depends specifically on which model. So I think for shared appreciation model, your risk is you're sharing in your upside, but the cushion is you get to share in the downside a bit also. I think for something like Divvy's model, it's much more similar to renting, where you could walk away at any point in time, we cash you out. There's not a very big obligation or risk associated for the consumer. I do think that there is a very big tie with debt levels, and so this kind of goes back to the point that James has sort of already made, which is you're seeing people come out with, in the past historically, from ages 30 to 40, the majority of their debt was mortgage, and now you're looking and it's student loan debt as well as mortgage debt. And so with these higher debt levels, people are using the models that we kind of have created to either reduce their debt burden and not have to take on a mortgage as soon, or find other ways that they don't have to tie up capital completely in a home.
Yeah. And I also think a lot of this, right, if you look at the 30-year mortgage, right, as an instrument, it was developed after the Great Recession. So it's been around for almost a century. Yeah. We don't think that's going away like at any point of time. And as with most industries where people have the choice of using debt or equity, dependent on what the needs are, what the cost of capital is, and what problem they're trying to solve. I think in the consumer space, you'll see the exact same thing play out, where they will continue to use mortgages or debt, but they will look to kind of equity solutions, whether it's shared equity and other options we're discussing here, as a complement. And over time, if it becomes a true alternative, I think that's a win-win for everyone, really.
Yeah.
If you're thinking about risks, there's clearly a risk with any financial transaction, and it's possible that when you're sharing your equity, that could cost a bit more than you would have paid if you'd borrowed the money. Maybe borrowing the money wasn't an alternative to you at all. Maybe you're an older homeowner that can't borrow because you're on fixed income, and the alternative is doing nothing, and then you accomplish nothing. Or if you're a renter and you're trying to become a buyer, and we can enable you to buy a home, what's the alternative? The risk is, okay, I'm going to give up some upside, but maybe not. Home prices may not go up; they may go down, in which case the funding has a negative cost. It's really great. But what's the risk of not doing anything? What's the risk of not buying? Home prices keep going up. It gets harder and harder to buy. I'm not building any equity, even though I'm sharing some of the equity. When you buy, you're building some equity rather than building no equity and putting your payment into a rental payment every month, and it's gone. So the inaction risk is big too.
Yeah. What about the risk for your companies? I mean, your companies are funded, generally by a combination of venture money and also some source of outside liquidity or debt. Like, what type of impact could a big recession have on you guys?
I think what generally so most of these businesses require operating capital and then investment capital. And I think what we are seeing on the investment side is that a lot of institutional investors are really interested in the asset class, because real estate is one of the largest asset classes in the country. And these investors have gone through economic cycles. They've gone through the recessions of 2009. They've gone through 97. So they are in it for the long term. And what happens often is a recession or even kind of a downturn actually creates unique investment opportunities. And it's our job as guardians of capital and guardians of trust to intelligently allocate that capital for them across macroeconomic cycles. So I think we see that a lot of our investors are willing to back it up for 5, 10, 15 years. And that's a great thing to kind of have that level of confidence in the market.
I just, for the audience, want to surface that an interesting thing in the investor community that we've talked a lot about is the phenomena of Blackstone and Invitation Homes, and people who historically were less interested in single-family assets getting more and more interested into putting money into that as an asset group. And I think for a lot of people in the institutional capital world, these businesses represent an ability to almost invest in individual homes, but rolled up into these big asset.
Do you think that there is a big distinction between the types of returns that venture capitalists expect versus the type of returns that a REIT provides, versus even on the debt side, what the returns are for a debt investor? So our venture capital investors are expecting much higher returns than the 8 to 9% that REITs have sort of returned, or even more so than the, call it whatever people tend to pay, but 6 to 12% that debt capital markets are actually looking for from us. So part of what's required in this job is not just creating a technology front end, but figuring out the structuring so that you're separating your assets between the actual homes, which you can lever and provide a certain return for, which is going to be lower than the actual technology front end piece, which your venture capitalist investors are going to require a higher rate of return for. And I don't think, maybe I'm wrong, but I don't think any of us would be able to operate with just using venture capital dollars. We all have to raise sort of debt facilities to help support that.
Absolutely. We've never actually raised money from traditional venture funds at all, because it's not the type of profile that we think makes sense for the business. We've raised money from much more patient investors. We also raise capital from long liability matching investors to fund the origination production. And those folks are looking to hedge inflation, essentially. And these are long-term investments as well. So, as we mentioned over here, the cycles, investors are generally willing to accept that risk. It's noteworthy that the money that we raise, by the way, is 30-year committed capital. So these investors are willing to put that money in for 30 years and bear that risk. And it's also noteworthy that we launched our programs before the financial crisis. Our platform was built to survive that type of situation. Our investors have come back after the financial crisis and re-upped with us. And we survived as a company going into the worst financial crisis hopefully any of us will see in our lifetimes.
Yeah, and we'd see very similar to what Adina was saying, where we just have different source of capital that are deployed in different ways. We have the traditional real estate capital, very similar to what you were describing, 30 years in long term. Yeah. And then we have the venture capital, who is investing not in Arene as the manager of the fund, but is investing in Arene as the technology platform for retirees, which offer one of them is the real estate solution, but is a much broader service.
And I think one other thing here that we're seeing interestingly is that a lot of investors who would traditionally put money into REITs are kind of shifting that allocation to models like shared equity because this seems, in their eyes, a much more efficient, a capital efficient, but also an operationally and management efficient way of investing in the same asset class without paying, say 5 points in operating cost and requiring a $1 billion portfolio. You can be very much, say, profitable at the unit level because of the way a lot of these platforms are structured today as well.
So what I actually want to call this out as a theme for the audience, and a lot of what we've been talking about is the way that technology is breaking things into little pieces and allowing people to more directly, whether it's as consumers or investors, access a group of assets that they might not have been able to historically. I do just want to ask you as we wrap up, guys, we know from our Slido that we have a lot of real estate agents, we have a lot of broker owners in the room. How are you working with the existing real estate community?
We are working more closely with them every day. One of our main focuses is helping more people buy homes by lowering down payments, by lowering the monthly payment. We have the only solution that actually does both. The mortgage industry provides plenty of low down payment options, but all of them increase the monthly payment. So it takes away one hurdle but increases the other. Our program actually does both. We lower both the monthly payment and the down payment. We work with a lot of large lenders around the country, some of the largest, and the sources of purchase business are the realtors. So we're reaching out to the realty community now to explain to them, this is all about giving your clients more choice. Location, location, location. Where they want to live, they can now afford to live comfortably.
Yeah.
They can get into the area they want.
I just want to cut you off, Jim, because I promised this audience that we wouldn't have sales pitches. So,
I can't help myself.
Yeah, I know. I just want to give you guys an opportunity to wrap it up in the minute we have left.
Real estate agents are our lifeblood. They are the people who send us leads. We are a purchaser of homes, so we buy homes with real estate brokers. We love them. And so for Divvy, it's a really symbiotic relationship where they still make their commission. We're just seen as the customer. And so we tend to work really closely with a lot of large brokerages.
Yeah, same for Arene. For us, real estate brokers are a fundamental piece of our strategy. We see Arene real estate product as a tool in the hands of real estate agents who have clients who are later in their life who want to stay home, but I can't afford it. And we give them a better option to sell their home or stay there.
Yeah. And I think for Patch, it's really about, we want to give both brokers and agents an opportunity to engage with the customers outside of the buy-sell transaction. You can be proactive, you can add value, to your customers by recommending other solutions, which can add value just beyond like the 3% commissions at the end of the day, really.
Great. So these guys want to be our friends. They want to partner with us. Reach out, check them out. Thank you so much, guys.
Thank you so much.
Yeah.
Good job. Thank you so much for that.
With design in our
I guess the mics go out much later.
And technology at our core, Compass is committed to improving the real estate experience for agents and their clients. Now we're taking that commitment one step further. Connected, configurable, and illuminating. Introducing the real estate sign, reinvented. Only at Compass.
Hey gang, it's almost time for you to be the speakers, and to set it up, we've asked two of the audience active participants, part of Inmanville, to give their quick summary of what they heard this week, and then we're going to come down off the stage, be in the audience with a bunch of mics. I hopefully can get some of my ambassadors to help. We're going to turn up the lights, it's time to just tell us whatever you think, like about the hotel, about what you heard, about the epic debate, or whatever. Anything you want to talk about, Vegas, not Vegas, anything. And this, by the way, is 250 predictions that was made by a bunch of executives and influencers, tech, real estate, that we're going to bury on the other side of the Golden Gate Bridge, and we're going to dig it up in 2025 and see how accurate they were. So that's something interesting. So now let's bring out, who do we got? Andrew and Sarah, come on out.
One more time.
All right, what a week. So, Brad opened up Connect this week by recognizing the upstarts and the skeptics and the outcasts and the incumbents, the confronters, the confronted. And so instead of loading the Connect stage with a bunch of hotshots from outside industries, instead the Inman team focused on getting those people on the stage to address the change that is upon us. And so while there are disagreements about the magnitude and the timing of that change, there's a tidal wave of change, and while some of the conversations might have been just a little uncomfortable, I think it's exactly what the industry needed to address the massive opportunities that are upon us. So for my first highlight was actually when Clelia Peters took the stage on Wednesday, and she's one of the smartest people in this industry. She's a unique perspective because she represents the old guard. She's the president of Warburg, which is an established brokerage in New York, but she's also a venture capitalist that invests heavily in this space. And so she talked about the stratification of the brokerage business into the future, and she used an analogy about the finance world and how technology has changed that. The bottom layer is full tech disintermediation, where the transactions are templated. That's like Wealthfront. She also talked about the middle layer, and that's where the Redfin or the purple bricks come into play. They are a combination of human and computers. That's almost like an E-Trade. And then finally, the full service layer that we're all familiar with, and that is more like a private wealth management service. And in the future, there's going to be even more pressure for that tier to deliver value. And so in a Slido poll, 92% of the audience agreed with this framework.
And the companies that you mentioned, Andrew, those are all companies that really focus on one thing, and that's a consumer experience. And one of my key takeaways, and it was from Inman Connect, when Jed Carlson, CEO from AdWorks, talked about Freddy's Diner, which was a diner that had 5 pages of on a menu, and it had everything, and it was there forever. And one of the things was, then one year, Dairy Queen came in, and then McDonald's, and then Subway, and then Freddy's was gone, because what Freddy's did was let the competition define them. So my takeaway was, don't be a Freddy's. Focus on, don't let your competition define you. Focus on the service you provide, because that will win every time.
All right, skipping right ahead here. There's a lot of talk about vulnerability. It was a recurring theme throughout the week. There were definitely moments of bravado on this stage. There's no question about that. But there were also moments of humility, and it really brings a question about what is the style of leadership that yields the best results. And so that might be an interesting question for Dr. Slido, but I think he's off the clock. Yesterday, we witnessed an incredible conversation with our friend Vanessa Bergmark of Red Oak Realty at CEO Connect, and she sat down with 2 former criminals. These are people who stole cars, they dealt drugs, and get this, at the table, there was a cop and a district attorney. So a really interesting combination of people, and these conversations have a tendency to lend perspective, because the chances are that the mistakes that you've made or that your teams have made pale in comparison to the mistakes that were either committed by or responded to from the folks on the stage. And so my biggest takeaway from that moment was this hotshot prosecutor who actually wasn't a hotshot at all. She's a servant leader, and despite witnessing some of the most heinous crimes known to man, she finds a way to treat all human beings with respect, even the defendants that she's prosecuting. And so she tries to put them in prison, but she also recognizes that they are people, they have grandparents, they have children, and they deserve to be treated like people.
And one of my key takeaways was with the Soul Pancake CEO, Shabnam. She was awesome. She did the thumb exercise. We're not going to do it now, but what it really did was give us a lesson in the power of perspective and how small shifts in perspective will make you see what you didn't see before. And I love what she's doing about the stories. And she had a lot of naysayers when she opened Soul Pancake. And they were like, yeah, that's a great idea, but no one's going to show up. 1 billion clicks later, they are a vibrant, amazing company focusing on stories that would have never been told otherwise. And if you know me, you know how passionate I am about this and the Woman Up movement. It's focusing on those stories.
All right, next up, we're going to change the subject and talk about Compass. Compass dominated this week, and we all love to hate the new kid on the block, but we want the new kid on the block, don't we? And so the controversial 60-year-old billion-dollar brokerage really took the oxygen out of the room at some points. I mean, the Compass-branded registration hall, the ads plastered all over San Francisco, the overflowing table at Rob Refkin's Meet the Leaders session on Wednesday. But this week, we learned more about how Compass markets. We learned more about their software and their vision. I found the biggest announcement from Compass was actually not their light up for sale sign. It was a new initiative called Powered by Compass, where independent brokerages, some independent brokerages, can leverage Compass technology. And so will others follow suit? I think the jury's out. Will brokers trust their data and their technology with Compass? Only time will tell.
Yeah, and speaking of tech-enabled brokerages, Redfin came out. Glenn Kelman from Redfin came out, and everybody wanted that Redfin to talk about what Redfin is doing, their IPO, their tech platform. And Gary did something really great. He asked everybody a question. He asked, how can we serve real estate for everyone? And this year marks the 50th anniversary of the Fair Housing Act. And so I challenge all of you to think about if discrimination is happening in your neighborhoods. And that is a map of redlining that is a fundamental issue today, still 50 years later. And one of the things that, you know, I took away with it was what I can do in this effort and how we as an industry can make a difference.
By the way, the mics are set up over here, so you can start lining up to say whatever you think.
All right, for my last highlight before I pass it off to Sarah, it was actually about a cordial conversation between Gary Keller and Brad Inman. It's kind of a snoozer, so back to you, Sarah.
Really?
No, I'm just kidding. So Gary started out actually quite measured, and he talked about the different paths that a business can take. Every business is on the same path at the beginning. There's a period of trial and error, and then at some point there's an inflection, and either the company accelerates or decelerates or it stagnates. And what Gary said is that the iBuyers like Opendoor, tech-powered brokerages like Redfin, even Zillow Instant Offers, they're still in that early period of trial and error. None of them have hit inflection points, and according to Gary, none of them have really truly innovated yet, which is interesting. And I think we have ghosts in the room.
Though, I gotta say,
There's a microphone on. All right.
Hopefully something interesting will happen. All right, so Gary closed the interview by making the case that agents and brokerages need to own their own technology the same way Netflix and Amazon do today. And so Gary claims that his agents spend $1 billion a year on software to outside vendors, and after KW releases their tech in 3 months, KW agents will be spending $0. So, hey, Elon Musk wants to colonize Mars. Big dreams.
So real quick, back to Earth and college. My last takeaway was with Chelsea Pietz. And she took us back to Psych 101 and Maslow's hierarchy of needs. And her point was that yellow, love, belonging, and connection is a fundamental need. It's arguably more important than the others on the hierarchy. And that reminds me of the name of this conference, Brad, Connect. And Brad has created this space for us to connect. We connect together, we bridge gaps, and those bridges change. They evolve, they expand. And this year, Glenn Sanford, 5 years ago, he was a crazy disruptor, right? But this year, he was the bridge between technology and tradition. And also, more importantly, he truly believes that agents are crucial to the transaction.
Great. You guys are fantastic. Thank you very much. Come on down here,
yep,
off the stage. And we have, by the way, wasn't Clelia just unbelievable? Would you come out, Clelia? I found a true partner. If I could also, I think Sherry Chris is going to help us here. If you guys could each take one of those mics and take them out to the audience so people don't have to get up. So I need Sherry, Clelia to come out. and we're going to get their perspective. Who wants to start? Who would like to speak up, say something? Just raise your hand or just speak up about anything. Yes.
It's my first time here. You guys may have seen me Facebook Living almost the entire conference and interviewing random people. I just want to say thank you, everyone who took the time to spend time with me, to get on my Facebook Lives and answer questions, give me advice for my first time here. Sherry, you're one of them. Thank you. And just thank you guys for being so kind and really connecting. It's a really good environment. That's all.
Anyone? Raise your hand. Don't be shy.